Happy Friday, everybody. Welcome into this week's long form episode on Mining Stock Daily. We have a 2-segment episode for you. First, doing some technical analysis with a new guest, Frank Cappelleri from Capp Thesis. We get into look at the chart, some of the big themes coming out of macro this week, including the move in the bond market and its effects on the equities. But we do spend quite a bit of time talking about silver and the silver ETF, and he's got some interesting charts to share about momentum in that area. And then we're going to stick with the silver theme and talk with our friend Mike Konnert from Vizsla Silver. They did a big deal last week and bringing in a new project, and you can see potential production on the horizon for the company as well, and the market has appreciated what they've done. So corporate update and on the silver market from Mike Konnert as well. Special thank you to Vizsla Silver and Integra Resources and Caliber Mining for their continued support of Mining Stock Daily. And as always, you can find this episode and a lot of the other content on clearcommodity.net. If you haven't, please go to the site, hit that subscribe button, leave us your email, and we'll be sure to feed you every day the moves in the commodity prices and the day's content that's been fed into the network. All right, everybody, thanks so much. Enjoy this 2-segment conversation, first with Frank Cappelleri and then with Michael Konnert. It's a real pleasure to welcome in for the first time Mr. Frank Cappelleri. So, Frank, thank you so much for doing this. How you been?
Trevor, great to be here. Thanks for having me. It was a pleasure meeting you at DirtCon a few weeks ago.
Yeah, it was a great pleasure. I've been getting some of your notes over for a while now. But to be able to actually, when you finally meet people in person and not just, through newsletters, you find, like you establish that rapport with one another. Like it was great to get to know you and have that introduction. Unfortunately, I missed your presentation because I had to dodge out early. But I was hoping that maybe we could revisit this. Listen, because this is your first time, we need some proper introductions. But
Sure.
I mean, you really lend your hand to your subscribers, through, the movement and the charts, a little bit of momentum. You got a really big picture. You're agnostics, you just do whatever the charts are telling you. So maybe provide a little bit of background, and to how you got to where you are with this, with Capp Thesis.
Great. Well, thanks a lot, Trevor. Well, I was on Wall Street for 25 years before starting Capp Thesis in 2022. And most of that time was on a broker's desk, but I was always had a technical bent. Got started really early at Smith Barney, 1997. At the time, I didn't know it, but I was working with 2 technical analysis pioneers, Alan Shaw and Louise Yamada, who were just outstanding people. At the time, they were already in the business for a number of decades, so it was a great spot to learn from. And that was from 1997 to 2000. So we rode that bull market. And I thought the best thing to do at that time was to buy the most overbought stocks as they were breaking out because they would never come down, right? Mm-hmm. And so then at that point, went to Instinet, which is a electronic brokerage firm, and they were expanding at that time. And it got there the week before NASDAQ topped. So then I realized buying overbought stocks in your all-time highs isn't always the best thing to do. But I got a really good introduction to 2 different markets within the first 6 years of my career. And so from that point, I was a sales trader for 16 years. And so I covered a lot of the biggest hedge funds and the financial institutions, and still, again, had a technical bent there. And so I got to see things on a very short-term basis, understand different algorithms or different types of orders that they wanted to use during different market environments. And then as my time progressed there, started doing much more content, eventually moved off the desk and was working more closely with buy-side analysts and also portfolio managers. And from that point, it really got a very good understanding of the type of analysis that was helpful to them as well. So a bigger picture point of view. And what I felt most interesting is that some of my best relationships I've had over that time frame was with really fundamentally driven managers, knowing that they didn't really need to pay attention to the technicals for themselves because, of course, they're talking to companies, understanding what's going on behind the scenes, but at the same time, knowing that market timing, understanding what the market is, whether it's a big picture view or specific to their stocks, is an important piece of the process. And that's where I really came in handy. of course, and taking that
Mhm.
knowledge and now bringing it to people outside of Wall Street, to financial advisors, to just active investors with interest in the market. That was my goal with starting Cap Thesis, which we now have done now for almost 3 years.
Yeah. What similarities are you seeing now with the Nasdaq compared to what you lived through in 2000 and that top and that bubble pop?
Well, I think just the amount that some of these AI stocks have gone up in such a short amount of time, and
Yeah.
I think it's undeniable that it's happened. The question is always, is it a bubble that needs to pop, or is it one of these things that's a new trend that eventually you'll see some of these long term, parabolic moves maybe just consolidate and then regroup and go up again. But I try not to get
Mhm.
too, I guess, obsessed with what's happened in the past as much. It's good to always have that in the back of our minds, but each one of these times is different. What is never different though is paying attention to price action. And
Yeah.
price action will, if you do it, if you have blinders on, which is sometimes hard to do on a continuous basis, but that allows us to again identify the trends and the patterns that come along with them. For as we can go over here, but really, I look at the market as a collection of patterns, and there's a number of traits that go into establishing an uptrend, and that's the same now as it was 20, 30 years ago. And sticking with those and always talking about that with our clients, it gets us at the right side of the trend, at least the biggest parts of those moves.
Yeah. A lot of people that listen to this podcast, and myself included, are definitely involved and invested in the precious metals space. And I think that inherently comes from we follow narrative and fundamentals more than we do maybe the price action, what the chart is given to you. And, oftentimes it's probably to our detriment. I mean, we get caught on the wrong side and we overthink the fundamentals, or maybe tend to get upset when gold doesn't behave the way we would expect it to or behave it. I mean, I guess that's the life we live as a traditional gold bug, I guess you could say here, Frank. But the reason I say that is because I think it's important. You do such a great job of it seems like you remove the fundamentals and the narrative and really focus on what the story is that the charts are giving you. How was that kind of a practice you had to lend itself? How do you remove like the noise from the headlines and just focus on price action?
It's a great question, and I really think it's being the fact that I got started. My career on Wall Street got started just using technical analysis.
Mm,
So at the time, the best thing that I recognized was that I knew what I didn't know. So that was one of the main reasons why I wanted to take that position, is because I was like, if I can start here, understand what the market is in general, how that plays out, it will give me a better understanding of maybe what sector to go into eventually, which, little did I know at that time it would define my career along the way. But one specific example I could point to, excuse me, was from, again, the late 90s internet boom. As you think about what was happening at that time, where anyone who touched anything technology related were doing well. I mean, how many times did we get calls from people outside the industry saying this is easy, right?
mm,
And people quitting their jobs to be day traders. And so one, I would say, avatar of that era that didn't really grasp that, of course, were anyone, say, in their 40s and 50s that lived through the crash in 1987, maybe the 70s, which wasn't like that at all. And so again, I was working with people that were at that age, and so one of the things that one of the reports that we did was just looking on the S&P 500's industry and sectors, and all we did was look at the relative line every week, right? If the relative line versus the S&P 500 was going up, we're either going to be in it, overweight, or at least holding something that we had for a long time. So that allowed this model to vastly outperform everything else. And again, it was just looking at the price action. So people that had lived through crashes like that and have not seen anything like this, didn't want to buy into it. But again, Luis and Allen, who I worked with, had those blinders on, and this was one way of doing it. So I think if you have a process that allows you to do so, it's much better than just trying to take all these parts together and like, where does technicals play in where my big picture idea is still intact, why isn't the price action working accordingly?
Yeah. Are you one of these guys, these technicians that when you when you put your trades on,
Mhm.
are you trying to get ahead of maybe moves and and trend reversals, or are you waiting for confirmations before you put those trades on?
It actually depends on the market, right? So
Okay.
if you're in an environment that's in an uptrending market like we've been in for the most part, at least through the end of 2024, breakouts were working. And so I look at the S&P 500, of course, first. And to give you an example, I identified 11 different bullish patterns along the way. 11 straight worked, meaning that you had
Mm,
breakouts that were followed through upon. You had a clean breakout. The whipsaws were relatively tame, which allowed that upside target to get hit. And after that, the process got repeated over and over again. So while it seemed like it was unsustainable along the way, what didn't happen during that time? Those digestive phases did not get resolved to the downsides. That means the bearish patterns did not play out. Now, again, that's going to be different looking at individual stocks. But if you look at the market in general, and that continues to play out, the majority of the names will look like that, even though we know it's heavily weighted with the top seven. But at the same time, there weren't too many stocks diverging too much. Now that
mhm,
changed a little bit, obviously, in the last few months, but that's what we're looking at. And then when that stuff stopped working, we started to notice that some bullish formations, some breakouts were failing. That's when there was cracks in the system. Now, I'm not saying that identified the waterfall decline that was coming over the ensuing weeks, but at the same point, it got us to be more cautious, or at least neutral during that time when those things stopped being successful.
mhm. Okay. Let's jump into a few topics with your charts. And if you are listening here on the podcast, I would highly recommend maybe, as long as you're not driving, drop it and go to the YouTube channel. We'll try to do our best to kind of walk us through orally of what we're seeing on the charts, but to visually see them, obviously, we'll be posting this on the YouTube channel. And Frank, I thought it'd be really interesting, is kind of picking up the biggest topic of probably this week, and that is the moves in the bond market. Uh, Wednesday's 20-year auction. I mean, it's just it's an obscure, treasury note, but it really kind of lit things up on fire and caused the entire bond market to sell off. Yields were rising. And then the equity markets retreated somewhat, and we actually had more than a 1% down day yesterday, which is going to be important because I've read a couple of your notes. That's an important theme as well that you have been writing about. So I think we start there with rates if we can. Walk us through what you're seeing here. What's the chart telling you?
Trevor, first, can you see my screen now?
I
The chart?
can, yeah, I can see
Okay.
it.
All right, great. So this is the 30-year yield, right? And it's on a weekly basis. And as we can see here, whether we're looking at this from, looking at the yield specifically or just a chart pattern overall, that's bullish. So if you're looking at this, it looks like looks to me a cup and handle pattern on rates. So rates going higher, which of course means bond prices going lower. And so one of the things we're writing about today is that, as you can tell, it's getting close to the highs from 2023, and we've seen it here before. So what the market has shown, or the equity market at least, has shown that it can still rally with rates moving higher as long as they don't move higher in an accelerated fashion. As we know from, look a lot different from the end of 2021 to October 2022, when rates, went up at a historical rate, of course, with the Fed raising rates as well. But then, it's not exactly like they started to fall precipitously after that. We're basically in a range from October 2023 all the way until now. And so I would say that a range of being higher, with market understanding that it can trade here, is obviously good for equities. But if we see a breakout like this and it continues to move at accelerated pace, needless to say, that's going to cause alarms for many different reasons, economic reasons, stock market reasons, and I think that will be difficult for the market S&P 500 to contend with. And it looks similar, of course, from a 10-year yield perspective, which I focus on more so. Now, the peaks and valleys will be a little bit different, but the same shape is there. And so, and a client asked me about this the other day, and one of the sections of our daily piece is called chart trades, which I identify a lot of individual stocks. And I was saying to him that if I saw this chart alone without knowing what it would be something I would put in as a bullish chart trade, meaning that I would
Mm.
want to buy a breakout. And usually those are more short term, but you can understand what we're saying here, where this looks to me like a bullish pattern on rates. And if we do get that breakout and that breakout doesn't follow through upon, it can obviously be a negative effect on the S&P 500 and equities in general.
Do you have, if you keep this 10-year U.S. Treasury yield chart up, do you have, if it does break out, any idea what a target would be for that next move where it might find, some sort of stability?
Well, again, this is a long-term chart. So if you look at the right side,
Mhm.
which is basically the handle of that, right? That can
Yeah.
actually be a bullish pattern in itself. And the reason I say that is because we want to have different targets along the way. So the first target would just be a measure move of that small pattern, which, say the low is around, 380 and the high is about 460. So you put that on, that's above 5%. And then once
Mm.
that happens, if you get above 5, of course, which was the top, back in October of last year, or 2023, you should say, it's definitely going to cause alarms. Now, the one thing I would say about yields is that they move much slower than we think they will, right? Because these patterns and a target out much higher, again, would really be a concern. But a lot of the times, once you get a strong follow through move in race, then you have a reversal and then maybe another higher low. So, if that happens gradually, that would be relatively okay. I think, or at least better for the market to deal with. If it happens, of course, in a very accelerated mode, whether things move up or down, equity market doesn't like that.
Well, let me ask you about that because it seems like over the last couple of years, since COVID, and I'm no expert on the bond market, nor am I as as good of a technician as you are, Frank. But it seems like there have been more days in the last few years with like multiple standard deviated moves that really have accelerated. Like, do you know anything about the frequency of those moves specific to the bond market, and if it's telling us just really about the volatility? I mean, we know the argument that the bond bull market has come to an end. That ended in 2022 if you look at the chart. So we're kind of in this like bear market scenario here for bonds, but it does seem since then like we've had some days where like the bond market really is moving in an accelerated pace compared to what has previously been in the previous cycle.
Yeah, I think that's you can't argue that fact, and the reason behind it, I don't know. I think maybe to the point where everyone's focusing on it now. There's much more
Mm.
in the mix, and people will understand and trade it maybe overnight, and there's just much more chatter overall. But I do think that you bring up a point where we've made a probably generational low in rates, right? That's probably not um, up for discussion at this point. And one of the things that I look at, or I don't have the chart here, but I'll share it with you, is again the 10-year yield on a monthly or quarterly even basis. And when we started to move higher a few years ago, for the first time since the early 80s, so like basically when it topped in 81 or 82, we had a overbought reading on the quarterly chart. And so
Mm.
what does that tell you? So if you look back the last time that occurred, again, that was the end of a huge run up. But you want to, when that type of thing happens, if you go back to the first time it happened, which was many years before that in the late 60s, it tells you that, yes, we have an accelerated move and we're probably not going to be turning much lower anytime soon. But again, we can have mean reversions over years for a 10-year yield, but I think this is moving higher in the years and decades to come.
Okay. Can I ask you to maybe put your kind of macro hat on and like kind of removing the chart a little bit? Where does this 10-year hit to where there's real implications for um, debt refinancing, federal government debt refinancing? Like, are we there? It seems like we're having a real hard time, even the current price action with the 10-year.
Yeah, and I think that it's important to realize that 10-year yield is one thing, mortgage rates and everything else is something different. I have a good friend who's
Yeah.
been in real estate for a long time, and he keeps on saying, he's like, when is this gonna change? Like, I'm not used to this volatility. I'm like, I know you are in the markets, but it's very difficult to talk to whether it's brokers or buyers at this point, and saying that to 30-year mortgage rate to 7%, even before this market, even before rates bounced here. So I think we're already there at that point, and it's going to take it's still some more time for people to adjust their thinking that we're not getting back to those levels near 0% anytime soon. Whereas it seemed like the norm back when our parents were probably buying houses for the first time with their double digit interest rates, at least mine. I'm a
Yeah.
little older than you, I know, Trevor, but at that point no one could even anticipate rates being this low. So I think anytime there's a regime change like that, the transition period is extremely volatile and tough to deal with, and I think that we're probably seeing that right now.
Okay. Very good. I remember, that moment at the DirtCon where somebody asked, how many people there, and there's probably 200 people in the room, how many people had bought in a home with a mortgage with a double digit interest rate, and I think one or two people,
Yes.
over time. So that's hard for me to fathom. All right. So obviously the bond market saying one thing is having implications on the market. So let's talk about, if you pull up the S&P chart, because this is interesting. And you've been writing a lot about the lack of 1% declines in the daily declines in the S&P. And yesterday, on Wednesday, we actually had one after the poor auction on the 20-year. So maybe walk us through the S&P. What are you seeing here? Like, is there a bullish case continuing here, or are we kind of? It seems like stocks are kind of exhausted where we're at.
Yes. Well, first I want to go back to that where I talked about how we had so many consecutive bullish patterns work out from 2023 to the end of 2024. So here's a chart that shows 10 of them. And you can see some of them are too small to even see from this perspective. But the point being is, this is an uptrend. If we looked at this without any annotation on here, it's obvious. But again,
Mhm.
what did we see here? Now I was going back to even 2022, 2023. Things really changed from my perspective, from being in a downtrend to an uptrend in the beginning stages of the second quarter of 2023, because that's when those number of 1% moves we talk about and track all the time fell off a cliff, right? Because we were averaging, say, 10 and 11 1% moves both up and down for the S&P 500 per month. And then suddenly in April, we got three of that year. And so
Mhm.
that then just led to the formation of bullish patterns and breakouts that then it really lasted until the end of 2024. And so along this way, a much bigger one had formed. We had a breakout through 4,800, which targeted 6,100, which we had 11 months later. So brings us to right now, coming off March and April, of course, extreme volatility, 12 per month. And so a lot has to change for that to go back to where we are now. And so one of the things we're looking at again is bullish patterns that started to form. Now we hadn't had one that worked out in 2025 until just a week and a half ago when our initial 5840 target got hit. And that produced additional bullish patterns, this being one of them, right? So you can see this is a cup and handle pattern that developed from the deluge that occurred in April and then the comeback from that point. So all along the way, we're trying to, again, identify some sort of character change. And again, from my perspective, that's seeing one of these things develop. And so this is an extreme moves, but at the same time, this is undeniable higher low at the end of April, which then produced pretty substantial upside target. And this has been identifiable across various ETFs and stocks, which I think was one of the major reasons why we've seen this extension so far. And so, and then as we know, strength begets strength. And when this occurred here, this is when things actually slowed down, right? Over the last month, only had two 1% or three 1% gains, and now two 1% losses. Whereas in here, there were just every other day or so. So that's the first
Mhm.
upside target, 61.25, and the second one is 65.55, much, much higher than the previous high. And so I get a lot of questions about, like, how confident are you on these lofty numbers? And I always say it's not about being confident, it's about understanding where the risk levels are for these to be eventually nullified. And so going back to that 6100 target, how did that get acquired? Well, we just saw there were 10 different smaller bullish patterns that had to play out for that to occur. So the same type of thing here, where I'm not going to hold on to the 65.55 target if things don't, if bullish patterns start breaking down again. But if we continue, say for instance, we consolidate above the zone, form another consolidation pattern that gets higher, then we eventually move much further beyond this breakout zone. And that's how that can get hit. But as you
Mhm.
mentioned, 20% up in just a few, number of weeks, that's a pace that can continue. So market now must show that it can digest constructively, form another higher low, and go from there.
Yeah, it's interesting. The dynamics behind this move too. It's been interesting. Hearing retail came in and bought the dip here. Was it last week or this week with just a vengeance, like over $4 billion in one day. It's just crazy. So it's interesting just the momentum retail is having. If you look at this, if you look at those headlines here, Frank, and look at this chart, the retail back when you were living through the Nasdaq push in 2000 and then the eventual pop. I mean, I mean, it didn't seem like retail was obviously part of pushing this thing higher, but it phased out pretty dang quickly. Where in this cycle, it seems like they just keep coming back and coming back, and maybe that's just a sign of how much money is actually in the system.
I think that, and also just ease of access. Right?
Yeah,
Someone
yeah,
walked
yeah,
over, right? You had to be at your desk, or people were still renting out space, right? The day trade
yeah.
at that time. Now we're just walking around with our phone. You order Uber Eats and place a trade at the same time. I'm sure that's happening, and sports betting for that matter. So I think that's one thing. I think what we run into is, again, if you get a lot of margin calls and things will really start to move in the opposite direction pretty quickly. And I think clearly that's what happened on the way down as well. And we can only really relate that, I think, to COVID at the time, where all the CTA programs took over and momentum really, accelerated to the downside. So I think, when you have a rally like this so quickly off the lows, retail
Hmm.
can forget about that pretty quickly. Whereas, of course, if you're institutional managers and you've been in this and you know what can happen, don't forget about that. And I think that's when you take precautions before things really start to move lower.
All right. So we're looking at your bullish case for the S&P. Do you have a bearish case? What would we need to see and what that might look like?
Yeah. So here's one of them. So I'm always looking at what a potential topping pattern will look like. So this is, of course, just looks at this rally as potentially ending right now. So what if this does? What if the yesterday's big down day was the beginning stages of at least extended pullback right now? And so, again, it's the reverse now. If I'm looking for, very simply, higher lows, which is the crux of a bullish pattern, a bearish pattern is lower highs. And so if we get some more downside follow through, I don't think it's going to be straight down once more. It may be, but if not, the next rally attempt is going to be the most important one. Where is that going to get us back up to this previous high that we just hit just on May 19th? If not, there's a lower high there, and that can develop into a bearish pattern. And again, I think it doesn't have to be any more complicated than that, because on the downside, the same type of thing happened. We only had one successful bearish pattern all the way from October 2023 through 2024. And then in the first 2 months of the year, say 2.5 months, saw three bearish patterns form, three downside targets hit pretty quickly, of course, as things rolled over. But at the same time, it was important to note because it just
Yeah.
hadn't happened before. And so now I think you had the reflexive rally much stronger than people thought would happen. Now you need to at least normalize some of these very stretched indicators that has been out here. The rubber band is surely stressed to the other side right now. And any sort of pullback that's bought, which is then fades right away, then you can see how this bearish pattern could play out.
Okay. Very good. All right. That's the big case here. We talk
Yeah,
bonds, we've talked equities. Obviously, you are on Mining Stock Daily, Frank. So we gotta talk some metals
do it.
if we can. Um, yeah, let's talk. Okay, you got the gold kind of placed in here. Obviously, we are having a little bit of a rally here. It's happened quicker than I thought. Actually, I thought we'd see a bigger correction, but maybe we will see it. Tell us what you're seeing here with the gold action.
Well, yeah, Trevor, good point, because as you can tell here, at the very end of this chart, it looked like to me, a topping pattern. And
Hmm.
we had that breakdown for a few days, but then, of course, buying came back in. And I have that highlighted because if you look at just the action, and we have a few charts here, this is the short term one, but the price action from August, what did we see here? We just talked about just consolidation periods resolved to the upside. So breakouts, they hit their targets, then consolidate again, and the gold continues to move higher. And that's really how an uptrend can continue the way it is. And so again, bullish patterns working, bearish patterns failing. Extremely simple, but really is anything more than that if you're talking about a trending asset. And so eventually, maybe you'll see a bearish pattern that works out, and we'll see if the downside target gets hit, and maybe that's a reversal that we're looking for. But on the other part of it, if you look on the bottom part of the chart, that's the 14-day RSI, which is just a momentum gauge. And so when you have an uptrend, typically the best case scenario is having it confirmed by this momentum indicator, the RSI. And as you can tell, the 70 level is overbought, 30 level is oversold. And when something is in an uptrend, that RSI oscillates between overbought and oversold. Now, maybe you don't want to buy it at the top of this range when the RSI gets above 70 and stays there. But at the same time, it goes back down to, say, around the 50 zone. That's typically a good spot to buy weakness. And so from a short-term perspective, that continues to happen for gold. Now, I can go to this monthly chart now, right? Looks at this pattern that was basically 13 years in the making for the most part, right? There's two different patterns in there. One we just broke out of in 2024, which is 3 years, but I'm talking about looking at that action from 2011 through 2012 as being a left shoulder of a huge inverse head and shoulders pattern, and this one is on log scale, and we can see how the breakout has worked. Now, as I was looking at this recently, it struck me that just how persistent this move has been from this perspective, this long-term perspective,
Hmm.
the post-breakout move. And that almost looks parabolic to me at that point, because it just hasn't, and it's even in the top part of that really steep channel. So you may think we have some sort of consolidation, wouldn't be surprised. But then going even further back, this is a 50-year chart now, right? So we're about 10 years into this move. The last big run was about 10 years, right? '01, 2011. And previous to that, around like late 70s to early 80s. So even shorter. But what's really striking is that the trough to peak move right now is quote unquote only 240%, but it's much, much less, right?
Yeah.
Than
Yeah.
650%, 700%. So not a prediction by any means, but it's, again, I think it's very interesting to have this perspective to see that it's about the same length as the last time, but still not even half the amount that it went up.
Yes. I mean, if you were to say double that 240%, I mean, I'm trying to do the math here in the back of my head, but that would take you probably about 5,000 an ounce if it were to at least get to 500% on that rally.
Pretty amazing,
Just
right?
wow.
But I
And
mean, yeah,
but that's over years, right? So like
yeah,
I think so people who may be listening and not seeing this from uh say 2000 to 2011, that move in gold was 646%, and from 2016 to present that move is only 240%. I mean, only
yeah.
still a meaningful move, but when you look at the comps for those big moves throughout history, like we're not even halfway there, which is pretty fascinating. But we're talking over a span of a couple of years, and so I mean, you could probably say, give it a little bit more time. This could happen quickly, or it could span out over the next few years.
Yes, exactly. And don't forget, if even gold suffered during the great financial crisis, you can see those, not well, but you can see in this log scale quarterly chart now. That was a pretty big reversal in the middle there, but it
Mhm.
didn't wreck that long-term uptrend. So expect volatility along the way, but just if and when gold decides to move lower by 10 or 15%, it may not be the end of this move. So again, that's why we're paying attention to the short term as well, because if bearish patterns start to work over and over again, then yes, maybe the trend is changing. But I think, it's given the benefit of the doubt to gold right now based on what it's been doing, how it continues to outperform over the course of the last few months to years even. Excuse me.
All right.
I think that it's not out of the question this could go higher, longer term.
All right. Can we talk about silver? This one's been a head scratcher. We talk about that gold silver ratio being kind of pegged at 100
Yeah.
anymore, and silver has just been hanging out in this tight range. We thought it might break out yesterday, but nope, could not do that, and getting hit again here today. It's interesting. Like it is just not. It doesn't have that beta with the gold move that it typically does. So, what are you seeing here in silver?
Yeah, I get very frustrated by that daily chart as well, which is why I'm not showing it today.
Fair enough.
Yeah.
Yeah, wide road. This is a great conversation. We don't need to get bummed out about anything.
No, but that being said, that's why I think you can see what this action, this is the monthly chart here, again in the log scale. So it's still above its breakout zone. And just as a side note, we talk about measure moves a lot in technical analysis. It's usually you're looking at arithmetic linear scale. So you're just using the price levels themselves, right? And it's not a big deal. Just, something's 10 points in height, add it to the breakout zone, 10-point target. But with log scale, since they're trying to quantify the percent moves, the breakouts or the measure moves had to be in percent terms as well. So with this particular chart, the move from the 2022 low to the breakout zone 2024 was about almost 60%. So 60% advance from that point would get us to around 43 or so. So anyway, still below that, and you can tell how long it has taken just to get not that much even further above the breakout zone. So I think big
Yeah.
picture, it's still there. The issue is that there's a lot of opportunity cost waiting for this to happen. And so I think you identify more so, I think like the SIL silver, miners ETF looks much more interesting to me. We have some charts of that, but I can't speak to why this is happening. It is frustrating, of course, especially for people like yourself, Trevor, involved in this space. But I think gold is, a trending asset and one that has utilized breakouts very well. So I would focus on that more.
Yeah, let's look at that SIL chart if you have it available.
Yeah. So I have this from a few different versions here. Now, I hate putting too many things on one chart, but for silver miners in particular, I think it's important to see what's going on here. Number one, it's been trying to test that 42 zone, and so from a daily perspective, this is a weekly chart. It's another small pattern, but as you can tell, it's already broken out of a pattern in blue here. And that target is again up near 49 or 50. Now it's been messy to get through it, but it's finally through that. And
Mhm.
all that action really from the summer of 2024 to now is produced in the right shoulder of a much, much bigger pattern that goes all the way back to 2021. And we can see that more clearly on the next chart, which is that same green pattern here. You see that if you had a
Yeah.
breakout, that would get us all the way up to the mid 70s. And that's part of an even bigger pattern that goes back to 2013. And so, again, very jagged. And you're not going to see this unless you, again, look at this from a very long term point of view and log scale. But this is the potential ramifications of if silver miners continues to move forward. Now, I'm sure it's predicated on silver itself actually doing better than it's had been doing. But this is what's going on underneath the surface. We're talking about huge bases that are being built, which is trying to leverage, and silver miners doing for now a better job of doing so than silver itself.
Is this kind of a typical cup and handle formation? This is what we saw with the gold price before it finally broke out. This big cup and handle, and then there was logs of what potentially it could hit. But I mean, it looks very similar here, but it's just taking its damn sweet time trying to get through it.
Yes. So looking at this pattern for a long time, but so,
Don't go crazy. I mean, you and every other silver bug.
yeah, exactly. So I think we have to realize it's there, and And again, along the way, as you mentioned before, Trevor, maybe it's one of these things where you do employ some mean reverting move strategies here just to catch the moves along the way before this actually breaks out. It's probably a way to play it. But understand that, this is taking shape and we start seeing these develop on a daily basis that eventually leads to weekly patterns being leveraged, so forth and so on.
Okay. Okay. All right. What else would you like to show us here, Frank? I don't want to be cognizant of your time, but there's probably a lot here that through this conversation. What else do you think our audience would be really keen to know and what you have available?
Well, I think Bitcoin is one we have to talk about. And I know that gold bugs and Bitcoiners maybe butt heads sometimes.
A little bit, sometimes.
Yeah. But I think Bitcoin number one, before we get into the chart here, I think it's a very important one to pay attention to. Um, Regarding the S&P 500, if you look at a chart overlaid in both of them together, it's very obvious that they really move in opposite directions for long periods of time. And when there's risky asset rally, what tends to outperform? Bitcoin. I'm not going to talk about anything else besides that underneath the surface because I think this one is proven so far that it is the mainstay, is the S&P 500 of crypto, so forth and so on. And so when you have a risky asset long-term uptrend, Bitcoin is going to outperform, or at least it has, right, up to this point. And
Yeah.
so this is as of this morning. So as you know, yesterday when everything was rolling over, Bitcoin was testing its highs and now above its most recent high. So coming into today, it was at about 110,000 or so. And so this is a weekly chart, and it's pretty clear inverse head and shoulders pattern where the right shoulder kind of isn't as developed as I would as like it to be if we're looking at a textbook like version, but I highlighted it in yellow because it looks very similar to the small right shoulder that was in play last year, and we had a very long multi-month inverse head and shoulders pattern also break out, and then of course go much higher after that. And so these numbers are tough to get our arms around sometimes because they're just higher and higher. But in terms of a measure move from this pattern, if it continues to hold, be 142,000. And so the other part of measure moves like this, you think about just because of math, the breakout, if you're looking at just like linear scale, that breakout percentage is always going to be smaller than the move that got us there, right? Just because of the denominator. So I think it just sometimes it's hard for us to grasp that one. The move is so much higher on the chart than, basically than the last high. But at the same time, I just find interesting you had a previous move from a low that was even more than that. So that's how I try to couch things at times. But that's the breakout. And the other part of this is that this is this weekly chart as well, but kind of zoomed out more to 2022. So this will also be viewed as a series of wedge breakouts along the way where you have some consolidation zones over the course of a few months. You have a breakout. And what I've highlighted here is that, again, the weekly RSI on the bottom, you can see how overbought those last breakouts got and how long those overbought conditions lasted. And that's what really got Bitcoin to those higher breakout targets in 2023 and 2024. So if you employ that same strategy to now, you can see that the RSI for Bitcoin is not even overbought yet. And if past performance predicts future results, which we know it never does, but if it does this time, then that means that this Bitcoin move could have more juice in it, eventually produce an overbought reading that could last. Now that is what could get us to that 142,000 target.
Fascinating. All right, Frank. I mean, this move in Bitcoin, it seemed like I would have expected it to happen earlier with the move higher in the S&P and the Nasdaq, but since the S&P and the Nasdaq has seemed to be kind of exhausted here, the fact that Bitcoin's now moving, it's pretty interesting. That challenges my thesis that basically it's just an analog to the risk going into the equities, and that thesis of mine is being put to the test right now. So, which I'm happy for it to do. It's always something that whenever you have a thesis to have it put to the test and maybe being welcome to be proven wrong. So,
without a doubt, I mean that's always looking for that as well. And what do you think is interesting too that Bitcoin actually topped about 6 weeks before the S&P 500 did this year. Now, again,
Mhm.
we're not saying that Bitcoin called anything that was happening with the tariffs, but it's also going to be important to see if this move fails too, and then we see a big reversal lower in Bitcoin as the S&P tries to continue to rally. That may tell us that the party's over for everything. So that's another way of looking at this. Because
What
again,
wouldn't that target be about 75,000 there? That the latest low on this chart that we're seeing.
oh, if it were to roll over,
Yeah.
yeah, I would say before that, just where it broke out from, say 85,000, 85 to 90 at first,
Okay.
because there was a support zone there. But other than that, of course, we've seen this retrace 80% of the time.
Okay.
So, nothing's out of the question with this. And it's either Bitcoin summer, Bitcoin winter, or crypto, I should say. You know,
That's right. That's
nothing in
right. All right.
between.
Frank, thanks so much for your time and walking us through these charts. A ton to look at and a ton to talk about. Obviously, we're kind of in this. Anything could happen, up or down, in all these different markets. Your newsletter, Capp Thesis, you can find it over at cappthesis.com. Cap with two P's. Where else can people follow you and maybe get in touch with you with any follow-up questions?
Oh, thanks a lot, Trevor. Well, there's also the free Substack newsletter, which is Cap Notes. So again, CAPP notes at .substack.com, and also been pretty active on YouTube. Just type in Cap Thesis there, and you'll see those weekly videos as well.
All right. All right. Thanks, Frank. Have yourself a great holiday weekend with friends, loved ones, and all that. So, and stay safe. We'll talk to you again soon.
Thanks a lot, Trevor.
All right, everybody. In our second segment here, we're going to stick with the silver trend here. While we were away last week, there was big news out of our friends at Vizsla Silver. They do trade on the TSX and the NYSE with VZLA, and they've made an acquisition. They are acquiring the Santa Fe claim packages to the south of Panuco. This actually brings in some metal production as well. So this is a pretty big game changer, not only for Panuco and really what the status of that potential mine project looks like for that, but really as a company as a whole. So happy to welcome in once again CEO Michael Konnert. Good morning, Michael. First off, congratulations on this.
Thank you very much, Trevor, and glad to be here catching up on the topic.
Yeah. So, I mean, this is a huge deal. And we've seen, this is kind of it's been a little bit of a theme we've actually seen the last year of, these developer type plays finding potential production that then they can bring into the portfolio and add some cash flow. Our friends over at Heliostar, Charles Funk, who I know you know very well, similar situation, what they've done in Mexico. So maybe talk about, this opportunity. How did it present itself? How long were you working on this deal? And really, how does this open the book for the general Panuco district, there outside of Mazatlan?
Yeah, so we've been working on this deal for probably about 2.5 years in total. This is the same vendor that we acquired the San Enrique concessions from, which sit in between basically Panuco to the north and then the Santa Fe to the south. It's another 10,000 hectare block that we acquired last year. So, this is a very important puzzle piece for us to consolidating this, what we consider incredible world-class silver trend that basically comes down from San Dimas through our La Garra project into Panuco and then south into San Enrique, now Santa Fe. So it's an important piece for us. There is, of course, the production angle there, which is very exciting. It's very similar to what we did in the first place at Panuco, where we consolidated two producing halves of the district. Our sights are set on something a little bit bigger than the 350 ton per day operation there. I think this would fit very well into our growing production story, with project number one being about 20 plus million ounces annually. I suspect that this could, in time, after we do some more exploration and some more work on this project here, add another perhaps 5 to 10 million ounces of annual production, somewhere in that range. So this will be an incremental growing step for us, and really important part of us just consolidating and being the dominant landholder in this district here that we think is probably the best on earth and probably the least explored out of all the Mexican silver districts.
Mike, correct me if I'm wrong, but this has been a private company up to this point, correct?
That's right. It has been, and Eduardo and Ricardo, the two gentlemen behind the company, have done an incredible job over the last decade plus of first of all staking this. They staked this ground. It was on a hunch that Eduardo had that this would be something very valuable, and I think as the legend goes that he beat some of the world's biggest silver companies to staking this property when he did that, and then over the years, they were very successful. They've run this mine very profitably, very successfully. I've been there. It's really well organized, very clean, and it was hard for them, I think, to part with this, but they were very excited to be a part of Vizsla Silver, and they received $1 million worth of stock for the San Enrique property, and now they've received a much larger share position, and that was really the selling point. They had other offers, but that was the selling point, was to be a part of Vizsla and to be a part of what's happening there in this region of Mexico, which of course they have continuity and history, and so they're excited to be a part of it.
All right. Well, it's good to be reiterated of a positive reputation in the area, specifically among those already operating, like they were at Santa Fe. This operation, as we said, is in production through the 2020 2024, produced over 370,000 tons of ore. Head grades include 203 grams per ton silver, 2.17 grams per ton gold. You kind of using that as a base case here, Mike, talk about the overall prospectivity of cash flows. Now, once this deal is officially done, bringing it into Vizsla Silver, what does that potential that cash flow situation look like for the company, maybe in the second half of 2025, if we say metals prices remain stable around these areas? And really, what is the strategy with that cash flow for growth and continued development with the flagship Panuco?
So we do have a period of time here where the operator is allowed to continue operating as we explore. We have now been very aggressive with advancing project number one. We don't want to distract our team from project number one with a new operation in Santa Fe until we're done the construction. So we have a 2-year period where they're able to continue to take and extract ore and use their mill while we explore for more material within that area. There's
within the Santa Fe area.
Exactly. Yeah.
Okay.
So we have the option to accelerate that the deal after 2 years and take ownership of the mill, and thus the revenue would be attributable to us. But in this 2-year period, we're doing work to make sure that we're comfortable with completing the entire deal terms here. So it's very similar to the original option that we did on Panuco. The vision here is, like I said, we don't want to have Simon's time now split between building something that's going to be 20 million ounces to focus on something that produces, call it 1 million ounces of silver equivalent a year. That would distract from the main goal here. But this is all part and parcel, and a big part of our exploration program can be looking at this whole area holistically. So the way that I would look at it is that, once we do take ownership of the project and the mill, I should say, and the production facilities, we'll likely have a very large resource that we can run through the mill. I would expect that a 350 ton per day mill would be too small for us, for our purposes. And so you'd probably see that grow to something like 1,000 tons per day, maybe a little bit more. So it would be complementary to what we have in the north at the original Panuco district, the project number one. And I think this will be another center of mass for us.
So do you envision Santa Fe being a hub for Panuco as well, or are we talking two separate mining situations, mining projects altogether?
It'd be two separate. Yeah, they're separated by significant hectarage, from Panuco down to San Enrique, of course. There is a road that connects them. The road is not a super highway like the toll highway that runs through our property. It's not that same level of infrastructure there, but there is some excellent access through roads. But really thinking big picture here, this is us acquiring something that I think has the potential to be another Panuco for about $16 million US, and then having permanent operating infrastructure in place. So it's an incredible deal. It was very accretive on the day that we announced it. It created about $85 million of market cap value for a $16 million deal. And I think, like you said, the markets responded very favorable to this. But I think the way that I look at this, and we're looking at a 10-year vision for Vizsla with incremental developments and goals that'll help us grow and become a very large silver producer. And I think you can see the first 20 plus million ounces of silver equivalent coming out of project number 1. We just now have bolted on Santa Fe, which could very well be that additional 5 to 10 million ounces. And then all the exploration that we're doing in the east, like the new discovery at Animas and some of those other structures out further east to Santa Lucia, could very well be another meaningful production center, could eventually rival what we have at project number 1. So certainly within 10 years, I believe that we can achieve a rate of 50 million ounces of silver equivalent production from this property map that we see. And then, of course, we have the Lagara project to the north, which is, it's not adjacent, it's not contiguous to Panuco, but has all of the same hallmarks as what we have in the primary district. And I believe that could be another center of mass for us as well, or multiple centers of mass. So we're very serious about achieving this goal, about building this company to be the best silver company out there. And this is a big part of that strategy.
Yeah. So how balancing the work at Panuco with now more exploration work at Santa Fe on your docket, talk about the budget spend for 2025. Obviously, it looks like the amount of money, it looks like that's going to be going out the door here, just expanded a little bit for good reason. But what does that trajectory kind of look like, balancing all the field work that needs to happen now?
Well, the good part is, first of all, we have 100 million US in the bank, so that we're well funded for any of these programs. And at the peak of our exploration, when we were doing 13 rigs on the property, hundreds of people running through the hills, sampling and mapping and that type of thing, we would have been spending maybe about $35-40 million US a year. These days, we're doing a couple of rigs, one at La Colorada, one at Animas. We're doing airborne and ground-based electromagnetics this year. We're doing a lot of sampling, mapping, that type of work. So this fits really well into that. You could see an increased budget, maybe of $1 million, $2 million a year on these properties like San Enrique and Santa Fe, and that will escalate, of course, as we continue. I suspect that later this year we're going to be in a position where we can say that we're fully financed for the project build of project number one, with very minimal equity dilution. And I suspect that having that fully funded status will give us the ability and the financial drive to go and make big discoveries. And I could see that exploration program step up in terms of costs and expense going into places like San Enrique, even Lagara, Santa Fe. But, we believe this is a very, very rich part of the Earth's crust. And, we want to go and make sure that we're finding it all and getting our shareholders the value for these deposits that are out there.
Yeah. You've got a full feasibility study planned for the second half of this year for Panuco here, Mike. So obviously we're about almost entering the second half of 2025, as crazy as that sounds.
Yeah.
What is the latest, what needs to happen? Are you in line to get that done here this year?
Well, we've, basically we gave the guys about a 4 or 5 day break after the PEA. So we've been kidding, but we've basically been going hard at this feasibility study, since the PEA with what we could do at the time. And then obviously since the updated resource with the M&I resource that we have of 220 million ounces of silver equivalent, that's been put into the mine plan here. The consultant on the mining is doing great work. That's feeding into the feasibility study. I know Ausenco has been driving that forward. And then our team, like Jose Fernando, who's our VP projects, and Hernando, our director of Mexico, everybody's been driving this forward very hard. I know the team's expecting to get it done certainly by the end of the year, and the pieces are coming together, which is great. But what I'm excited about is, we had a philosophy even with the PEA where, although we didn't have that M&I resource in place, we estimated what could be used as an M&I resource, which would suggest that would be the mineable resource that we have. And we use that for the PEA. Instead of using the 365 million ounces that we have globally, we used what was most likely going to fit into a mine plan. So with that, the incredible economics, which I should point out too, are the best in class. We just saw Gato, Silvercrest, and Mag now taken over, and we're preparing a good side-by-side comparison slide for our presentation that we'll be able to share. But our consensus NAV is the highest of those comparables, and the economics are head and shoulders above those comparables as well. So we're already outstanding in our peer group, but as we go into the feasibility study, I don't expect that those numbers are going to have a negative variance. I think they're going to be in line with what we saw in the PEA, which is something that those peers I don't believe achieve. So it's quite a feet, and it's something that I'm excited about. Usually, these feasibility studies can be a neutral or even sometimes a negative market experience if the expectations are too high and the reality is too low. But I think in our case, I'm expecting that the feasibility study will be a very positive release for the market.
Let's talk about the market response here with the equity following the news with Santa Fe project being acquired. The investors liked it, the market liked it. You are kind of approaching those all-time highs. You're not quite there yet, but those all-time highs made in 2021. Remember that time vividly in the fall of 2021. I'm looking at the U.S. market here, not the Canadian one, but the U.S. You're about a little less than $800 million market cap. But this is obviously positive momentum. You're seeing development in the company, investors like it, and then but you're seeing this silver. Like the silver market where it's just like is having a real hard time busting out of this consolidation area, but it's still healthy. $32 an ounce north of that. If you're a silver guy and you're a silver miner and you're not making money at $32, I have no idea what you should be doing something else. Let's just put it that way. But talk about the market response here following this news, even despite the silver market kind of being like in this no man's land.
Yeah, well, I think there's a few things. One has to do with scarcity value. And I talked about Mag, Gatos, and Silvercrest now being gone. Even Adriatic, it looks like it's going to be taken over by Dundee Precious Metals. They've been talking about that. So there really are no other silver companies like ours at this stage, single asset near-term producers with these types of grades and a CapEx that's now less than a third of our market cap. So, we're getting a lot of attention because of the lack of really any other names in the space, but also because of the extreme quality of what we have here. And I think investors are trading out of Mag ahead of the deal and waiting towards Vizsla on an institutional level. So that's very helpful. But, we have constant meetings with our investors and our shareholders and other groups. And there has been just a lot of interest in what we're doing, because a lot of investors understand that this is kind of that beginning of that golden brick road towards production, where you see a PNAV multiple go from 0.5 times to, in Silvercrest's case, or in that peer group's case that I talked about that was just taken over, 1.8 times NAV on average at that acquisition price. So there's an incredible path forward for re-rating, one that we're very well funded for. So the equity dilution risk is very minimal. And I think that's probably why we're seeing a bit of a re-rating here. But in my opinion, at 0.5 times NAV, we're still very undervalued for what we have planned here and what I know is coming down the pipe. And that's to say nothing of new discoveries that we've made. the potential here, it's an extremely fertile place for new discoveries, and of course we're drilling for new discoveries, so the prize can keep on getting bigger as we de-risk project number one. So I think that's part of it. And the other thing, of course, silver market is in some ways difficult. And I quit Twitter for some time, and I found myself back on it recently. And it's funny. It's like it's like all these accounts tweeting about silver's about to break out, silver's about to break out, and I have to admit, I think that was the same that we saw 6 months ago when I stopped looking at it the last time. And anyways, everyone's often calling for the breakout of silver. I think it's probably a lot closer than certainly it was 6 months ago. I think we're starting to see a lot of indications that the lag behind time is almost over here for the metal, and it should catch up to gold. But it's important to note that Vizsla at these gold prices is probably very close to a 50-50 gold to silver. It could even be slightly more favorable on the gold side in terms of economics. So we do benefit greatly from the gold price. What's really incredible, though, of course, is and we don't use spot prices for economic studies, but the price that we published the PEA was $26 silver and 1975 gold, and that was still $1 billion plus 1.1 billion NPV, 9-month payback, and 86% IRR. Today, it's it's well into the triple-digit IRR. It's probably a 5-month payback, and it's $1.5 billion NPV. So we do see some benefit, of course, from the metal prices that have moved already.
What's the mood there with companies out of Vancouver, or even the banks and the analysts, Mike? Do they trust these prices in gold to be maintained? I mean, I feel like people are real skeptical about it because we've been here before, but at the same time, it's like it's almost one of those things where it's like you're a little bit fearful of these high prices because it means like all these like old crappy projects are dusted off the shelf once again, and all of a sudden they're trying to raise money for moose passion when it's just rather be capital should just be flowing into the better projects such as Panuco.
Yeah, and then it kills that capital, and it doesn't return. Especially
Right.
when you start to see generalist and broader retail investors come in without the specialization in mining, and they get sucked into some of these projects that shouldn't exist, and it just kind of puts that what could be promising capital to bed forever. I find for the space, and we saw a lot of that in 2020. Just to think back to that 2020, and then in 2021 got wiped out. And I think a lot of those people are probably fearful of the space, but there's something different happening here. This is, I think, a lot brought on by the record debt levels in the West, and the BRIC nations buying bullion for their central banks. That's a directional and structural shift that I think we're seeing. And that's for on gold, but of course on silver, the industrial demand of silver is driving the price higher as well. And silver does behave like gold. It does work as a precious metal, and it does have that safe haven asset value. But we're seeing about 50% of demand driven by industrial, and that primarily from solar panels. And China continues to build these solar panels. That doesn't seem to be slowing down. Of course, the silver panels that have been built will have to be replaced in a cycle as well. So there should be incredible demand continuing for silver, and this is the 5th year now of that structural supply deficit, which is what's dragging the price up. Now, at some point, it will explode higher and match gold's run. It has every time there has been a major move in the gold price, silver does lag and catch up. I'm not one to say that just because the silver gold ratio is 100 to 1 that it needs to return back to 40 to 1 or something like that. But I do think that we'll see a $40 plus price level on silver. It could even be very possible by the end of this year. It's a tight market. The paper trades are what generally keep it down. But I think at some point these moves can be much bigger than those markets, and the price should be very buoyant.
All right, Mike. Good to connect with you. Glad we could end the week with you and get an update here out of Vizsla, and obviously a huge transaction and really just more positive developments coming out of the company. Vizsla Silver does trade on the TSX and the NYSE with VZLA. They are a partner of the podcast. I'm also a shareholder. And Mike, we got a long weekend here in the United States, so don't put any news out on Monday. It's going to be quiet.
Okay.
All right, everybody. That's a wrap here this week. We'll be back Tuesday. Have a wonderful holiday weekend if you're out there celebrating Memorial Weekend here in the States. And be safe, everybody, and be well.